All right. Everyone should be able to see my screen here. Good evening, everybody. Welcome to the Wealth Mindset and Real Estate Investing virtual meetup. My name is Chris Price. For those of you who I have not had the chance to meet yet, I'm the host of the Wealth Mindset and Real Estate Investing meetup, and I'm also managing partner at Boost Capital Group and the CEO and co-founder of Red Fox Multifamily. Before we get into tonight's event, I'm going to just do a brief intro of our meetup and then also read out a couple of sponsors. For those of you who are not familiar with the Wealth Mindset and Real Estate Investing meetup, this is more than just a meetup. It's a community of action-oriented professionals who are serious about building generational wealth and sharpening their financial intelligence, whether you're a busy executive, business owner, or retiree. You're here because you understand the power of real estate investing, but you may not have the time, network, or specialized knowledge to scale your portfolio on your own. That's exactly where this group comes in. And our mission is to equip you with the insights and strategies and connections you need to confidently invest in commercial real estate, especially multifamily, through passive, professionally managed opportunities. Each session is designed to help you grow your wealth mindset as well as your financial toolbox. We'll discuss practical frameworks for building and preserving wealth, all while reinforcing an abundance mentality that empowers smart decision-making and long-term success. So whether you're just getting started or you're ready to take your portfolio to the next level, welcome. You're in the right place. And so let's build wealth together. And what you should also know is that we're sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios, add passive income, and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get across the U.S. from our trusted network of top operators in the best markets throughout the country. Partnering with Fox Multifamily makes investing in real estate completely hands-off, allowing investors to add passive income, build equity, and save on taxes, all while being in an investment vehicle that is backed by a hard asset. And we're also sponsored by Boost Capital Group. Boost Capital Group's vision is to become the premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. And as I always do, for those of you who haven't had a chance to meet me, I love connecting with people. If you want to connect with me, you can scan the QR code or shoot me an email at chris@boostmycapital.com. I'd love to have a conversation to talk about where you are in your real estate journey and to share a little bit about me and my team as well. As far as the agenda goes for tonight, we are going to do an introduction of the speaker for tonight. Our speaker is going to give a presentation. There'll be a little time for Q&A. And then if time permits, we'll also have a little bit of an opportunity to do some virtual networking, just share where we are, what you're trying to achieve, what insights you're seeking, etc. So let's take advantage of that at the end of the presentation. Please mute your lines when you're not speaking. If you can, hold your questions to the end. But of course, if our speaker wants you to be engaged in the presentation and offer questions throughout the course of the presentation, by all means. This presentation is being recorded, as I mentioned before. Please know that this material does not constitute an offer or solicitation to purchase or sell securities. And please also note that this is for information purposes only and should not be construed as business, financial, or legal advice. So with those logistics out of the way, let me introduce our guest speaker for tonight, Mr. Michael Albaum. Michael is someone who means a great deal to me. He is someone, when I first got into the real estate investing space, looking to grow my knowledge in this space, which started out as just a small curiosity about investing in real estate and building a portfolio in real estate, I didn't know where to turn. And I stumbled upon a Brief Stock Academy at the time, and that just hit me square in the eyes. I was deep into this space of trying to learn everything that I could on my own, listening to all the podcasts, watching all the YouTube videos, scouring the internet, reading the books, doing all the things to try and increase my mindset and my ability to learn more about real estate investing, but didn't really have any structured program. And I felt that it would be beneficial to me to have that. And lo and behold, I ended up coming across Stock Academy and Roofstock in general to then start to pursue my more formal real estate investing education. And Michael was one of the proctors there, someone who was experienced in real estate investing and teaching us all the ins and outs in a very structured way through online learning, through live discussions, and a host of other things, made himself so available. And to have him on the meetup this evening is just truly remarkable for me because it's a full circle moment. Someone who's really benefited me and impacted me on my journey to where I am from a real estate investing perspective, to now have him come and present and share where he is now on his real estate investing journey is just, I have so much gratitude to Michael, and I'm so grateful for this opportunity for him to be on the show tonight. Without that further ado, let me give you a little rundown of who Michael is in this brief bio, and I'm sure he'll get into more details in a moment. But Michael Albaum started his real estate investing journey over a decade ago with turnkey single-family homes. Realizing the true power of real estate investing, Michael spent the next 10 years, 10 plus years, in fact, acquiring and operating properties remotely, including single-family residences, condos, small multifamily, commercial multifamily, value add projects, triple net leases at properties with national chain tenants, short-term and mid-term rentals, and international investments, all while working a full-time job, which is also something that I can attest to, being both an entrepreneur and professional. Michael has developed a curriculum to help others achieve similar success and has worked with thousands of investors globally. So if you would please join me in welcoming Michael Albaum to the meetup. I am just looking so forward to tonight's presentation and hoping that all of you get a lot of value out of this as well. Without further ado, Michael, let me stop sharing and let me turn it over to you so that you can provide an overview for the team.
Thank you so much, Chris. And man, if you couldn't see me, I'm blushing. I got this ear to ear grin. I appreciate the warm welcome and super happy to be here with everybody this evening. And thanks for taking the time out of your busy schedules to come hang out with Chris and myself. So we will just hop right into it. I am a co-founder at a company called Bold Street AI, and we are labeling ourselves the disruptive partner for real estate investors. And we're here to talk tonight about how to finance your next deal. And like Chris mentioned, I want this to be very conversational. We're a small group tonight. So if you have a question about anything that you see on the screen, anything you hear me say, feel free to just throw it in the chat. Chris will be monitoring that. We can stop and talk about it. If you don't have questions, feel free to save them till the end, and then we can talk about it in the QA session. I want this to be very conversational. I want to talk with you all. As Chris mentioned, this is me in a nutshell. He gave me a way warmer welcome than I'm able to give myself. I'm a Bold Street co-founder. I'm an investor, real estate coach. I'm also a fire protection engineer. And so you'll probably see some of that engineering mentality come through in a lot of what we're talking about tonight. So we're going to get really deep in a couple different topics. By no means do you have to feel like you're an expert or even follow all the math. But what I want to have everyone come away with is just high level concepts of, hey, here are the things that I can do and apply in my personal situation. And that's what I really looked to do when I was working at Roofstock and developing the curriculum there, like Chris mentioned, is take people from theory to reality based on their own situation. So we're going to talk about a lot of different things, and hopefully it's going to spark some ideas that will resonate with you that you can then go implement to help yourselves scale your portfolio wherever you are. So quick background on Bold Street. We're a team that has a lot of experience in the tech sector, in the institutional space, and then just in greater real estate in general. And we work with institutional clients. We work with brokerages. We work with top performing agents. We work with loan originators and property managers. And the whole point of this is to help investors source better deals faster. And so we've developed some proprietary AI software. It does investment analysis, helps match you with deals across the country, both on market, and then we're also building an off market platform. So deals that you would never have access to or see, we have access to. And then you basically build out your own formula, your own criteria. It's called a buy box. And it'll automatically underwrite deals based on your own criteria and say, hey, Chris, these are the top 5 deals in your particular market that you should invest in. So we're going to be talking today about types of financing available, the pros and cons about some of those, dig into some examples, and then we'll talk about Bold Academy at the end here. And I speak in math and equations. I try to go as slow as I can and dig deep where I can. If there's something that you have a question on, throw it in the chat. We will tackle it right then and there. So There's just a bunch of ways to finance investments when it comes to real estate. Here are just a handful of them. There's the conventional, which we're probably often familiar with, the 15 and 30-year mortgages. We've got refinance options as a vehicle to actually go and finance our next deal. We've got FHA loans, VA loans, commercial loans. That's a requirement if you're going to finance a unit or a building that's 5 units plus, but actually you can put a commercial loan on a single family home. There's cash, there's debt service coverage ratios, there's self-directed IRA retirement accounts. There's various creative financing vehicles, seller financing, assumables, 1031 exchanges, private capital, and hard money, to name just a few. Just something to keep in mind that as an owner occupant, we are going to be getting access to the cheapest debt available. And as owner occupants, we can often leverage existing real estate into additional real estate, kind of this snowball effect. We're going to use what we have and leverage it into additional purchases. House hacking is a great way if you're just getting started or even have an existing portfolio to continue growing or building the portfolio. House hacking is simply buying a primary residence that's larger, whether that's more units or more bedrooms than you need for yourself, your personal living situation, and then you rent out the additional rooms or units. And so you can go get conventional, traditional financing on a 4-unit building, live in one, and then go rent out the other 3 and potentially live for free or even make money. This is something that my wife and I did in a duplex here in the Bay Area, California, because it was so expensive. DSCR loans, this is like a hybrid between a commercial mortgage and a conventional mortgage in that it looks to the property to carry the debt as opposed to you as the borrower. And so in the commercial world, the underwriter or the lender is going to look to the property and say, hey, if you can't make the mortgage payment, can the property support all of the debt service? Hence the name debt service coverage ratio. So these are amazing vehicles to get into our next investment. And then, of course, retirement accounts. There are some very strict rules about do's and don'ts, but can be often accessed for investment purposes. So again, some pros and cons about the various types of vehicles out there. So a HELOC. This is an acronym. It stands for Home Equity Line of Credit. These are typically available for owner-occupied properties. I was able to get one on an investment property, but I owned it free and clear. And so this is a second mortgage that's going to be recorded on the property, but it's essentially like a credit card. Now, if you were investing in real estate in 2008, you might be thinking credit card, HELOC, real estate, bad. The reality is it's really important to understand how these can be used and how they should be used to determine whether or not it makes sense for you. And again, just very high level, we can typically get up to 90% of the equity available in a property on a HELOC. And that's simply taking the home value, multiplying it by the loan to value the lender will give you, subtracting out your existing mortgage balance. So in this example, if we had a $500,000 home with a $250,000 mortgage on it, we would be eligible potentially for a $200,000 line of credit. Some of the pros, it's super flexible when it comes to gaining access to the funds. Once you have the HELOC established, nobody is going to ask you, what are you using the money for, and underwrite your deals and underwrite you as a borrower. You simply have access to those funds on a moment's notice. They can be super rapid to fund. So if you decide you want to tap into it, you need $200,000 tomorrow. It takes as long as it takes for a check to clear in order for you to have access to those funds. They're often minimal qualification process to set up. They're often free to set up. I just went through this process and I'm pretty sure it was free with my lender. They can often have very low interest rates and they often have interest-only payment options. So that's a pro. Now, some of the cons are a variable interest rate and also interest-only payments. So it's important to understand how these should be used and also how they work, the inner working mechanics of it, to make sure that it's the right vehicle for you. But again, we're just talking about tools in the tool belt. You get to decide what the best tool for the job is based on your particular scenario. So let's talk about the cash out refinance. This is very similar to traditional lending. Some of the pros, is often inexpensive, especially right now as owner occupants compared to investment property loans. It can help maximize cash on cash returns. We can often have long-term and fixed rates, and it can be a great hedge against inflation. We're taking some of the equity off the table and using it to reinvest in new properties. Some of the cons, they can be expensive to originate. Depending on what type of lender you're working with, they might be charging you an origination fee, potentially points up front. Just again, something to keep in mind. Qualifying can be like pulling teeth. Anyone who's ever gotten a conventional mortgage will tell you it's like a full cavity search. They want to see your tax returns. They want to know who delivered your mail for the last 5 years. They want to know who you've ever spoken to. So it can just be a painstakingly slow process. So keep that in mind if you're thinking about trying to move quickly. The cash out refinance is something you want to plan for well in advance of actually needing those funds. Another con is that you're restarting the clock on paying back the mortgage. So you're going to be very heavy on the interest portion of the loan repayment. So if you're 5 years out from paying off a loan or paying off a property, you just want to think long and hard if that makes sense to do for you. The traditional financing, again, very high level, often inexpensive, can help maximize cash and returns. Great to be long-term and fixed. Great hedge against inflation. Cons can be expensive to originate. Qualifying can be slow. Typically, these are going to be inflexible loan products as well. Cash. Closing a deal in cash is like one of the best things ever from a process. Cheap and quick to close deals. You can close deals really quickly and you can often get a discount on the purchase price. You also don't have to worry about mortgage payments. So your cash flow on a monthly and annual basis is going to be maximized. There's no better way to maximize cash flow on a deal than by paying all cash. Some of the cons, you're paying all cash. So it requires the full amount of cash upfront for the deal. If the market value changes on the property or decreases, your equity can evaporate. And this can also hinder your return metrics. There's this balancing act between cash flow, true dollars in your pocket at the end of every month and every year, and metrics. We could very easily engineer a return and maximize the return metric cash on cash, for example. But I always give the example. Let's say you get your cash on cash return up to 27%. It's like amazing number. Everyone says, yeah, of course I would want to make 27% cash on cash return. I say, okay, now let's look at the cash flow picture. You're making $1.27 a month on your cash flow. And if somebody sneezes at the property, it's going to go negative. Would you want that? Most people say, okay, no, that doesn't make sense. And I say, conversely, what if I could show you how to buy a property that would yield you $2,000 a month in cash flow? Would you be excited? Most people say, yeah, of course. Michael, what kind of question is that? And I say, okay, but your cash on cash return is 0.2% because you got to go spend $2 million in down payment to buy that cash flow. Would you want that? They say, oh yeah, no, maybe that doesn't make sense. So we don't want to look at these two things individually, cash flow and the metric, whatever metric we're using. Cash on cash is the common one. We want to look at them in unison and in concert and see how do they play off one another and make sure that we are balancing and engineering both of them such that the deal makes sense for you. And again, Chris and I could buy the same exact deal with the same exact type of financing, but he puts a little more cash down. I put a little less cash down. He might have a better cash on cash return, but he's probably going to have a weaker monthly cash flow. And that could work perfectly fine for him. So again, it's all about structuring the deal and engineering the deal to make sense for you. Cash partners is another great way to fund your next deal. They can bring the funding needed to close the deal. They can also bring experience and insight. They can eliminate mortgage payments, depending again on how the cash partner is being brought into the deal. Some of the cons is you can have too many cooks in the kitchen, which can change the decision-making dynamic. The relationships are now at stake because now you're working with another person as opposed to just a lender or the professional relationship. And now other people's money are at stake. And it could be somebody, friends, family, acquaintances, private capital, and hard money. Some pros can be very flexible terms, can be super rapid to fund, can be much easier to qualify than traditional financing. And again, anytime you're using OPM or other people's money or debt, it's a great hedge against inflation. Some of the cons, it can be very expensive to originate. It might not be a good long-term solution. And it's likely going to be more expensive than traditional financing, both in the short term and the long term. But again, we're talking about all the different tools in the tool belt, and this is absolutely a great one to consider. Owner or seller financing. This might or may not be a thing that you all are familiar with, but it's basically where the owner plays the bank for you. So instead of, if I'm going to buy a property from Chris, instead of me going to a bank and saying, okay, please give me the money to then give to Chris to buy his property, Chris and I just work together and Chris goes, yeah, Michael, I'll sell you the property, but you have to pay me a mortgage payment as opposed to this third-party lender. There are unlimited options with regards to flexibility and deal structuring because now it's just Chris and I working together, figuring out what does he need and what do I need. And we've got a whole lot less underwriting hoops to jump through. Chris just has to decide if he's willing to play bank to me, Michael, an individual, or the entity that I'm using to buy the property. Some of the cons, it can be more expensive than traditional financing because if Chris is going to lend to me, there might be some risk associated with that. So he's going to want to return premium for that. Now I'm indebted to somebody that's not a professional lender. And so Chris and I are in this deal together and he's not a professional lender and I might not be a professional borrower or investor. 401k, retirement accounts, these is one of my favorite ways to finance deals. Can be super flexible with terms, can be very rapid to fund, much easier to qualify for than traditional financing. Typically, you're answering a couple questions in an online portal. And it's a great hedge against stock market volatility. If somebody borrowed from their 401k 6 months ago, took money out and missed this whole bear market, they would look like a genius. Now, of course, on the opposite side of that coin, the opportunity cost is definitely a con. So if we then come back into this bull market, you're going to miss out on that run up. Can be expensive to originate. I don't think they're very expensive to originate at all. They're typically going to be very cheap, if not free. Might not be a great long-term solution because a lot of the products out there for lending are going to be shorter term. I'd say anywhere from 1 to 5 years is what I typically see. And so it's not going to be a good long-term solution. A lot of custodians out there have various products or terms about borrowing from your 401k or retirement accounts if you're going to be investing directly into them. So there's a loan, and then the retirement account can often buy the asset itself directly. And then all of the loan payments come out of the account and cash flow payments go back into the account. Again, super cool way to buy real estate, but there is definitely some nuance. So just want to make sure that you are digging into it. Some examples that we are going to run through. The biggest takeaway is we're going to run through this example of using a cash out refinance on a primary residence to invest into your next deal. So the purchase price is $180,000, down payment is 20%, closing cost is $4,000. So in this example, that's a $40,000 down payment. We're literally going to siphon off $40,000 in the form of a cash out refi from our primary. And we're using today's interest rate. So I'm calling it 7%. That's fixed for 30 years. That equates to $266 a month in payment. Then we're going to go get financing, very traditionally an 80% loan to value on this property. That's also going to be fixed at 7% for 30 years. And that has a monthly payment of $958. And let's call the rent $1,900 a month in this example. We're going to say it's new construction. And so we're going to use an expense ratio of 30%. And what an expense ratio is, for anyone that might not be familiar, is for every dollar I bring in, how much of that dollar is going out the window to pay for operating expenses, not including the mortgage, such as property taxes, insurance, property management, repairs, maintenance, vacancy, those type of things. Those are operating expenses. They all build up. And so we're saying if we bring in $1, we're going to pay out 30 cents of operating expenses. Then we're going to pay out the mortgage. Whatever is left over is going to be our cash flow. So the way that I like to underwrite deals is if there's debt associated with a property or used for a property, I lump it in when I'm underwriting the deal. So somebody could take a look at this and say, Michael, you're using $40,000 from property A, your prime residence. That has nothing to do with this deal. So how should we factor in the debt? In my mind, my opinion, this is totally my opinion, because we're using this $40,000 to buy property B, I want to make sure that property B can support that payment, because if something happens to property B, I don't want to lose my primary home. So when we run through the math here, we're going to take our rent, $1,900. We're going to subtract out our refi payment of $266, subtract out the mortgage payment of $958, and subtract out our operational expenses of $570. And what we're left is with $106 a month in positive cash flow. So the big question is, how do we calculate our cash on cash return? Cash on cash return is simply annual cash flow divided by our total cash into the deal. So we know our annual cash out is 106 by 12, which is 1272. What about cash in? What should we use? Our cash into the deal is 0. So our cash on cash return in this example is infinity. You and I put no money of our own into the deal. We borrowed all of the down payment and the closing costs. Our bank account, our checkbook has no debit showing up in it. So we literally created cash flow in this example. So we created what's called an infinite return, which is just like the best thing ever when it comes to real estate investing. So let's run through another example really briefly. In this example, everything is the same, except we're using a HELOC for the down. And it's something that actually I just did. I signed my closing papers yesterday for a quadplex up in the Pacific Northwest. We used the HELOC for the entire down payment and all of the closing costs. We're borrowing $40,000 against it. That's going to be an 8.5%, but let's say it's fixed for the first 12 months. Let's use that as an example. And so that is $283 a month in interest only payment. Again, our same 80% financing, 7% fixed for 30 years, $958. And again, same expense ratio. And so in this example, we're taking our rent minus our HELOC payment, minus our mortgage payment, minus our expenses. We're left with $89 a month in positive cash flow. Okay, so now I ask you again, we're trying to calculate our cash on cash return. So what do we think our cash into the deal is? Again, infinity. No money out of pocket came out of our pocket. So again, it's infinity because we're not using cash. We're not using cash that we had. We're using a lending vehicle or a lending product that we're, of course, going to be paying back over time, but to fund our deals. So again, you might be thinking, you've still got to pay this back, and the 266 only covers the interest-only portion. The thing to remember about HELOCs is the interest-only portion is a calculation of how much of the line you have drawn down. So in one of those first slides, we said maybe you qualify for $200,000 based on that particular property. If I only use 40, my monthly payments are going to be calculated on the 40. If I used 50, it's going to be calculated on the 50. The fact that I have 200,000 available doesn't factor in here. So again, it's like a credit card. You're only paying back, and your interest payment, you're only paying back on what you're using. So the way that this works is we take the balance and we multiply by the interest rate, and then we divide that number by 12. Rough general example, roughly $266 a month. So let's use that as an example. We're getting $106 a month in cash flow. And so as we're paying off this mortgage, we can attack the principal balance. If we take all $106 of our cash flow and we're throwing it at the principal piece of the HELOC, our next monthly interest only payment is going to be slightly less. And so again, if you're using a HELOC, I love the snowball process here, the snowball effect. I'm taking as much as I can and throwing it at this HELOC to pay it off as quickly as possible. That's going to do two things. One, it's going to decrease my monthly payment in terms of the interest only payment that's due for that HELOC. And two, it actually frees up available cash to then go use that HELOC again. So that's kind of the cool thing. It's just like a credit card. If you've got a $200,000 HELOC, you're using 40, and then you get a bonus from work and you pay off 10,000. That means you've only got 30,000 outstanding. Now you get access to that 10,000 again. So it's this revolving line that typically is good for about 10 years. Again, don't worry about the math here, but just think about if you're going to use a HELOC, make sure you've got positive cash flow above and beyond the HELOC so you can pay off the principal part of that HELOC. As soon as you pay off a portion of it, it becomes immediately available again. There's no underwriting. There's no hoops jump through. I personally love using HELOCs as short-term money, or think of it as a bridge loan. So I share with you all, I'm closing on this fourplex. I use the HELOC for the entire down payment as well as the closing costs. I'm also going to be using the HELOC for some renovation costs. Once that property sells, I'm going to take the proceeds from that sale and pay off the HELOC. At the end of the day, I'm going to have a property that's going to perform just like it would if it was traditionally financed at 80%, or in this case, happens to be 75%. Let's talk through the Bold Academy really briefly. This is your all-in-one real estate education hub. I pioneered and created a program at Roofstock called Roofstock Academy. That program has since been shut down. I was super passionate about helping people get started investing or scale their portfolio, meeting them where they are, whatever it is looking to do with real estate. So when that program got shut down, I went and created my own. We've got over 20 hours of flexible on-demand learning style resources. We got tools and resources. We help you overcome doubts and really craft your personal investment blueprint to then help you master investing strategies and build generational wealth. So again, this covers a lot of what's in the Academy. If I didn't say it before, it's free. We give it away. There's no gimmicks. There's no gotcha. There's no catch-me's. So we got, again, tons of courses, and it was designed to be very soup to nuts. If you have heard about real estate investing but aren't sure how to get started, we've got stuff for you. If you're a more seasoned investor and are looking to either scale the portfolio in the existing asset class or branch out into some different asset classes, we've got stuff for you. If you're trying to get involved in some different strategies, trying to do midterm rental, short-term rental, long-term rental, come check us out. We've got stuff for you. We've got cheat sheets that help summarize and distill down what the lesson is talking about. We've got pro formas. We've got really great tools. This is, again, built for investors, by investors. So all of the stuff that I wish I had access to when I first started investing is what I created here, and we're constantly updating it. So if there's something that you think would be valuable, that would be helpful to your investing, just let me know and we'll create a tool for it. We also have a podcast, again, totally free. It's called The Remote Investor, and you can come check us out wherever you get your podcast, Apple, Spotify, Google, all those spots. We talk about all the things that I wish I knew about when I first started investing, as well as all the various things you can do with real estate investing, all the different ways to invest. And we focus on doing it remotely, since that's what my bread and butter is. I live in California. 95% of my portfolio is outside of California. And I'd say 80% I've never seen in person. So I'm a big proponent of doing it remotely and not letting your physical geography be a limiting factor. because it just wasn't available to me. So I was forced to go abroad across state lines pretty quickly. Bolt Street, it's the number one place for residential investments. We'll help you find deals, we'll help you analyze deals, and we'll connect you with the various players you need, whether it's property managers, lenders, agents, to get those deals done. Bolt Street AI is the website, and that's my email, michael@boltstreet.ai. Would love any questions that anybody has. I know that was a mouthful. It's probably drinking from a fire hose, so I apologize for speaking so quickly. Any questions you have, throw them in the chat, unmute yourself, email me if nothing comes to mind now. Would love to talk through any and all of this with you all.
Well, Michael, this is great stuff, man. And I do encourage everyone, if you have questions, you can hop off of mute and ask them live. If you prefer, you can type them into the chat and I can read them out loud. To get things kicked off, Michael, you talked about so many great things. And one of the things that I often speak about is this, you talked about leveraging HELOC, or leveraging the equity that you're building home, your primary residence, or in other assets that you have. And I think this is so important. There's the concept that I've heard this most talked about as is equity harvesting. So most people think about trying to pay off your primary residence or your rental properties and have no monthly payment on them from a mortgage standpoint, and no debt. And basically what we talk about in the real estate space is that equity being trapped within the walls of the home. But in the concepts that you shared, the idea is, no, don't do that, because you could harvest that equity. You could invest that equity into other assets that create cash flow out of thin air, as you talked about, and then continue. And those assets also appreciate in value if done correctly, and add more equity and value to your portfolio. People oftentimes rinse and repeat that process, but talk a little bit more about the mindset that someone needs to have around this concept of getting to a place where they can think about the movement of money and harvesting that equity to buy assets.
Yeah, no, it's such a great question and point, Chris. Okay, so let's talk about just the mindset here for a second. There are a lot of people that want to be debt-free for one reason or another, and I get it. And so if your goal is to be debt-free, investing in real estate is challenging to do, but there is a way to do it. And so there's a gentleman by the name of Chad Carson. He's an awesome coach, author. He's a guy, bigger pockets. He talks about smaller being better. And so he talks about the various lifestyles that people are trying to live. And he gives an example of somebody with 5 units, somebody with 100 units, somebody with 1,000 units. And they all go on vacation together. And the people with the 5 units have a very simple life, a very simple portfolio. And they knew they wanted to only have 5 units. And so what they did is they bought 5 units with debt over time and then paid those off as aggressively as possible. And so I think it really comes down to understanding what's somebody's goal and where is somebody trying to get to. Because Chris, if you and I have different goals, we're probably going to be using different strategies to achieve those goals. And so our paths could look wildly different, and as they should. And so we also come from different backgrounds and have different experiences. And so we're going to draw on those to make the decisions that's most appropriate for us. So first and foremost, I say it's really important to define the end goal, define what done looks like, define what success looks like, because that's going to be your North Star. And then we can reverse engineer of how to get into done. So the second thing I'll say is when I realized that every dollar I went to pay off the primary mortgage in my home, I have a 2.875% on my old primary. I will never pay that off quicker than I need to, because that in itself is an asset. And so every dollar that I'm paying into paying off that mortgage is essentially earning me a 2.875% return. So I could do that, or I could take my dollar and I could spend it on a different investment. It doesn't matter what it is, stock, bond, real estate, any investment, and probably earn better than a 2.8% return. So it comes down to also understanding, how does that dollar you're spending impact your monthly or annual cash flow? And when it comes to fixed mortgages in general, that dollar that I spend to pay off my mortgage sooner doesn't impact my monthly payment. It doesn't change anything for me until the mortgage is fully paid off. Now, there's no argument about it that paying off a mortgage early will save you interest. When we look at the total amount of dollars you pay over the life of that mortgage, it tends to be about double. So if you borrow $300, you're ending up paying back $600, because that's the way 30-year mortgages work, or whatever the time frame is. You pay back a lot more than you originally borrowed. But if you look at that piece of data on itself, you're like, oh crap, of course I want to pay off my mortgage early. But what if I told you if instead of doing that, you could invest in another property and make way more than what you're paying back in delta on your mortgage? And so the example that I love the most is, let's take two investors, each having $100,000. Investor A invests all $100,000 and buys one property all cash. Investor B buys five $100,000 properties and puts down 20 grand each, right? Investor A, 5% appreciation. So that 5% appreciation is on the asset value. So we're going to see a $5,000 increase. Investor B sees that same 5% appreciation, but again, because it's on asset value, that's 5 times $500,000. So we're seeing $25,000 of appreciation because it's asset value, not dollars invested, is where we see the appreciation take hold. So when you start to think about things in as a global portfolio, as the whole picture, as opposed to slices or individual pieces of a pie, it's called portfolio theory. It starts to get really interesting, and you start to really understand that, wow, how impactful debt can be, and actually how much better of an investment from a pure mathematics standpoint it is to often not pay off mortgages early, but instead go invest those in other assets. Now, if somebody is listening on the call and says, hey, you know what, I've got a 10% mortgage here, would you recommend I pay that off early? Possibly. So again, because now your dollar is earning essentially 10% when you pay off that mortgage early. So it is very specific. There's not a one size fits all, but oftentimes leverage is a way to gain access to additional equity faster.
Such a great response. And I think that's so important for people to know. That mindset piece is so key, because a lot of people get stuck on that. But if they open their minds and look at it in the way that you just described, it can really open up a lot of doors. I still don't see any questions yet. So again, I'll ask another one. And you talked about investing with your retirement account. This is another very powerful strategy that I think people need to think about. And the way that I view it is around diversification. Most people's retirement accounts are focused on mutual funds and other investment vehicles. Your company sponsored investment portfolio manager, whether that's Fidelity or Vanguard or name one of the large firms out there, they're just simply taking those funds and allocating the funds that can then give a return. And of course, everyone knows about the fees and the taxes that are collected before you will see that money at the end on that retirement day. But as Michael mentioned, this year is a great example with all of the volatility in the marketplace. People have watched their portfolios be riding high one day, and then all of a sudden, boom, the bottom drops out and can wipe out a significant portion of your return. So one of the things that I often talk to investors about is, hey, think about diversification. One of the ways that you can diversify your retirement account is being able to harvest some of those dollars in company sponsored account and put them into either a self-directed IRA or a solo 401k as an example. And then you can invest in things that are not correlated with the stock market, i.e. real estate, like what Michael's been talking about, and then be able to have that asset, that all the returns that you generate from that real estate property work the same way as if it were invested in a mutual fund. Instead, it's just going back to the retirement account, all the cash flow, the proceeds, if the property sells or refinances, goes back to that retirement account, and you're able to build up things in that way. And that's a great way to diversify and not have so much of your portfolio exposed to the financial markets. But Michael, talk a little bit about the mindset again, what people need to be thinking about when they're approaching this from a retirement account perspective to be able to really get into that space.
Yeah, totally. So there's actually two different ways to invest via retirement accounts. One is taking a loan from your retirement vehicle. And this is something that I did. So I was closing on a property. It was my second one ever. I didn't have enough of the down payment. So I went to my retirement account, was able to take a loan, use that cash as the down payment, and then make mortgage payments, loan repayments to myself with interest back into my own retirement account until that loan was paid off. And so at the end of the day, I ended up with more money in my retirement account than I originally took out. Because again, all that interest I'm paying went to myself. So that's number one. I owned the property outside of my retirement account. Me, Michael Albaum, as an individual, I owned the property, and I used funds from my retirement account via a loan to finance the deal. The second way is just like you mentioned, Chris, is the retirement account actually owns the property itself. Something I learned several years back, which blew my mind, is your retirement account can often take on debt as well. And so if you're someone that's thinking, oh, I don't have enough money in my retirement account to go buy a property, you can go get debt. The retirement account itself can go get a loan for an investment property. So like you mentioned, there are all of the benefits that come along with real estate investing, the appreciation, the cash flow, the loan pay down in a lot of instances are still the same, whether it's inside a retirement account or outside a retirement account. The one big difference is going to be the tax benefits and how it's treated inside a retirement account versus outside. So you want to understand those very clearly before making an investment inside a retirement account. I think this is a great place and a great way to diversify the portfolio. And something that I just want to mention really briefly, Chris, is something called sequence of return risk. And so that essentially is if you have to draw on your retirement account in retirement, and they say the golden rule is 4%, you should never draw down your retirement account. It essentially should last to infinity at that point. But let's say in 1 year, you need to take 10% because you had some life event, you need to take a bigger chunk. And in that year, the market is way down. So now the market is down and you're taking out a chunk of your retirement. That is going to be very difficult to come back from unless the market rebounds in a big way. And so what if instead of having all of your money in the stock market, you had stocks here and a piece of real estate here? And for this life event, instead of going to your stock market pool, you just went to the property pool and you either refinanced, took a cash out refinance, grabbed tax-free money from the property, or you said, you know what, I'm done with the property. You sold it. Then those funds go to the retirement account and then you can access them in your everyday life. And so you don't need to touch the stock part. And so it's important to be able to have the ability to pick and choose when you are tapping into your stock portfolio in the retirement account. And if all it is stocks, you don't really have that luxury. So I love what you said. It's a way to diversify. It's a way to break free from all of the volatility. Again, you're missing out on the upside, but you're also leveraging the downside. You're minimizing the downside. And I think the best investors are the ones that focus on minimizing the downside risk.
Oh, there's a question here in the chat that I'll go ahead and read out for you, Michael. So the question is, what kind of lenders should I approach regarding borrowing funds using an SD IRA? How much would I realistically need to have in my SD IRA to be able to invest?
Yeah, great question. So there are SDIRA specific lenders. So if you Google them, you get a whole bunch of results. And because it's a unique vehicle and a unique process, I saw that they were lending, and this was probably in 2022, 2021, when I looked at it, they were able to lend 50 to 60% loan to value. And so based on whatever the price point of property you're looking at, I would say have at least 60% of the property inside a retirement account. Good question.
Yeah, absolutely. And to Michael's point that he made earlier, it is important to strategize with your tax professionals around those things, because there are some considerations that may need to be discussed in your particular situations. We aren't here providing tax or business or legal advice, but there is something called the UBIT tax. Those are things that when you talk to your CPA about this strategy that you're thinking about executing, you can have them guide you through the optimal way for you to pursue acquiring a real estate asset with debt and using your retirement account. Any other questions? Otherwise, Michael, I do have a few questions that I'll put to you as well as we start to bring this to close here and get to some Q&A off the recording. So what I like to do, Michael, and I did not mention this because we put people on the hot seat here and we want to ask you a few questions to give people an opportunity to get to know you a little bit more and for you also to share more about the great venture that you have with Bold Street. So first, I know that you're a big traveler, you and your wife, and I would love if you could talk a little bit about what was one of the best trips that you've taken and why.
That's a great question. So I think one of my favorite trips is my wife and I went to Morocco. We went to Fez, and it was just an unbelievable experience. The Moroccan people were so hospitable. The food is amazing. The culture is amazing. Such a deep and rich history. It's a gorgeous country. We had so much fun. And it was just a totally unique and different experience than anything we had ever done before. We were staying in the old part of the city in the market, and everybody is haggling and trying to get you to buy something and wants to sell you something. And it's customary to haggle for price. And so it just wasn't something that we were used to. People were yelling at us and grabbing us and telling us this and that. It was totally overwhelming, but we got the coolest stuff. We ended up shipping a bunch of stuff home because it was things we just can't get here in the States. Spices and rugs and leather goods, and big pride in handicraft and making things by hand there still. So it was just an amazing experience. Highly recommend anybody go check it out if they're feeling adventurous.
That's amazing. That is definitely on the bucket list, and being able to connect there. And I've heard so many great things, and I will be reaching out to you for tips when my family and I make it over there.
Please.
Now, you talked about Bull Street, and that's such an awesome venture. I would love for you to talk a little bit more about what some of the special things or exciting things that you guys are working on over there that maybe can get some of our listeners and those who will be watching on the recording even more excited about the great stuff that you guys are launching.
Yeah, totally. I appreciate you asking. Bull Street is like this amalgamation of a lot of ideas coming together and a lot of refinement. And so what it was originally intended for and was originally built for was as a platform for real estate agents to work with investors more seamlessly. Because we all know real estate agents, probably multiple of them just in our social networks. Most of them aren't doing very many deals, if any at all. And the ones that are probably working with investors, because as you and I and everybody on this call knows, we are constantly looking for deals, as opposed to your owner occupants goes and buys a house, lives in it, moves maybe once every 7, 8 to 10 years, statistically speaking. My co-founder, Chris, he wanted to empower real estate agents to be able to work with more investors seamlessly and to be better at it. Because many real estate agents, I'm a licensed agent in California, I went through the agent training, doesn't talk about investing. There was like a paragraph that talked about investing, but they're really not equipped to be able to work with investors. And so he was like, oh my gosh, there's this blue ocean opportunity to help these folks. He built a technology platform that basically searches the entire MLS and allows you to build a custom buy box based on, this is for the agent, based on their investors' investing criteria. So if an investor came to the agent and said, agent, I'm looking for a 3-2 single family home in Atlanta, Georgia, that cash flowed $150 at a 7% cap rate. The agent could go in and put together that buy box, run our algorithm, and it would automatically search all of the listings in Atlanta and highlight 20 or 30, whatever the results were, and say, hey, these are the ones that meet your investor's criteria. And they'll click a button, they can get sent to the investor. So when I saw this, I was like, Chris, this is incredible. I said, the only problem is that 95% of deals today start on the buy side. The investor finding the deal, bringing it to an agent and saying, hey, can you take a look at this? Let me know what you think. She was, oh my God, if we do this all backwards. I said, we have to get this technology to be investor facing, not just agent facing. So that's what we're in the midst of doing right now. So we are building out this platform where you can go online and search every single market in the country, every single MLS that's available right now. You can put in your filter criteria, just like you could on a Zillow or a Redfin, 3-2 single story built in 1970, what have you. But then you go in and you put your financial filter on top of that, and it'll run through whatever property, whatever area you're looking at, and highlight and tell you, hey, these are the properties that meet your criteria, or these are the ones that are close. And right now, to date, we don't know of another technology or platform that does that. And this is all for free.
Oh, that's incredible. I'm so excited about this now as an investor, and for some of my realtor friends who in context out there, for them to be able to be exposed to this as well. So I'll be sharing this with them. And you talked also about the education platform, the combination of having the resources to be able to do this from the actual tool and platform combined with the educational aspect of it just is really a powerful combination for people. And what I'd like to encourage people to do from the offer that you put out here today is to make sure that they get connected, make sure that they register for the training, go through all the modules, take action and leverage this tool because it could really help turn some things. I have 2 more questions for you, Michael. The next one is one that I love to ask people because the name of our meetup here is Wealth Mindset and Real Estate Investing. And of course, one of the things that we often talk about is the idea of financial freedom. job optional and all the different types of things. But when you think about financial freedom, what does financial freedom mean to you?
Yeah, you're only asking good questions tonight, Chris. I love it. It's the ability to be job optional, to have your passive income or income from something other than a job cover your living expenses, whatever that is. If you're a renter, cover your rent. If you're a homeowner, cover your mortgage. If you are living lavishly, cover your lavish lifestyle. It's simply dollars that are working for you. It's something probably that you put in place yesterday, so to speak, that's going to pay you tomorrow, and it's going to pay you a year from now. It's going to pay you 5 years from now. A job is traditionally not those things. At the end of the year, the end of the quarter, or however your job is measured, you start over. And the work you did last year doesn't count for this upcoming year and for the following year. Maybe you should do more of it because you did so much last year. So now you're ready to handle more. That's typically how jobs work. It's simply having money that can fund your lifestyle, that you can decide whether or not you want to work. I know tons of people that have become job optional and continue to work because they really enjoy their job. They get a lot of life satisfaction or derive a lot of meaning from the work they're doing. Others quit their job and go work for a nonprofit and don't take a salary or are able to take a massive pay cut because the thing that they love to do or are passionate about didn't pay enough to pay the bills to support their lifestyle. So now they have this other engine driving the bus, so to speak, and they can just feed it a little bit of gas here and there, for an automotive analogy.
And then lastly, in the same spirit, you talked about a lot of concepts today. And again, part of the name of this meetup is wealth mindset. And a lot of the things that you talked about today conceptually may be difficult for people to be able to really understand. Again, most people we go down the path of go to school, get a good job with benefits, pay off your mortgage, live below your means, all the different things. But you talked about some stuff that are really pivotal from a mindset perspective. Talk a little bit about what having a wealth mindset means to you.
Yeah. So I think it's just about being able and willing to swim upstream. So I got started over a decade ago. Real estate investing was not nearly as popular as it is now. The tools available today were non-existent back when I got started. And so the support structure that I had is very different than what's available today. So the fact you put this meetup together is like unbelievable. You're like a decade too late for me, but I'm still so happy to be here and be a part of it. At the time, people thought I was crazy to be buying properties out of state that I'd never seen before. What are you doing? That's insane. And so I had to put up with the naysayers and the doubt and the negative self-talk that I had for myself of, wait a minute, all these people are saying I'm crazy. All these people are saying it doesn't make sense. Am I missing something? What do they see that I don't? But I was just so determined to get out of my job because I knew that I wanted to live bigger than what somebody else decided I was worth. And so I was running away from something, but also towards something at the same time. And I know it's cliche and I know it's always talked about when it comes to mindset, but having a why, having this like nuclear reactor, so to speak, for yourself is so critical because I've had my lunch eaten more times than I can count. And I was financially independent and then fell out of financial independence because of some decisions I made on a project. And this has not been a fairy tale butterfly story for me. In fact, for most people, it probably isn't. And if it is, I would question that. There's probably some other motive there. But
Yeah.
so I think it's just having resilience mindset and knowing that the end goal is worth it. And so that's why it's so important to have this why, to have something that's going to drive you to get up and to do the hard things when it sucks. Because I promise you, I hope I'm not the first one to tell you. I hate to be be the bearer of bad news, but this industry will suck at some point if you're in it long enough. And so you got to be willing to face the tough times. And again, for all the cliches and all the soapboxes, I apologize, but I think it really epitomizes, and it's so important to go into this with eyes wide open, that if you're going to get into this business, it will be hard and you are going to have to do things that will probably make you uncomfortable. So just get ready for that. And I think that will help drive you. If you know that going into this, those hard things just aren't as hard. It's the people that think this is going to be easy and it's all fairy tales and butterflies that when they encounter something difficult, realize, oh shoot, I wasn't prepared for this. So
Yeah.
prepare for the hard stuff and it just doesn't become as hard.
Oh my gosh, that's so powerful. And I know there are many people out there listening here live and that will watch this on recording and say, yeah, I really needed to hear that, to keep persevering, keep pushing through. There are going to be some good days. There are going to be some tough days also. And how it builds you, but doesn't break you, I think is so important. So thank you so much for sharing that. Michael, tell everybody and remind everybody how they can keep in contact with you when they want to find out more about Bold Street, find out more about the trading, the platform, keep in contact with you before we wrap up tonight.
Yeah, I appreciate it, Chris. And thanks again for putting this together. This is a ton of fun. I love what you're doing. Like, you're got an awesome mission, man. Keep up the great work. So boldstreet.ai is the website. You can email me directly, michael@boldstreet.ai. You can follow me on LinkedIn. I'm Michael Albaum. Twitter, Michael Albaum. Instagram, myfi Mike, MYFI, My Financial Independence Mike. Those are probably the best places to find me. And all the training and stuff is, again, totally free. It's on boldstreet.ai. Come check it. Hopefully it's helpful.
Awesome. Michael, thank you very much for your time tonight. Thank you, everybody, for joining. I'm going to stop the recording now. If you have any quick questions for Michael after I stop the recording, please do shout out. Otherwise, we'll end the session, and I wish everyone a good night. Thank you.
Take care, everybody.